that investors are looking at a broader range of diversifiers, and that in itself I think we can completely understand given the balance of growth and inflation risks at this stage. However, I think it would be amiss to not look at some of the more reliable diversifiers. When you think about real assets, for example, to me they have a much more consistently demonstrable ability to hedge against inflation. So yes, gold seems to be the popular place, but I really think it's important here not to overlook areas like infrastructure, timber, transport, real estate, which to me are much more consistent diversifiers over time against the inflation risks that investors are looking to position against.
What about bonds? Because we've heard a bit of everything. 60-40's back, others say it's definitely not back. We've seen a wild ride even in April for the yield. Would you be looking at the long end of that US Treasury market?
So for me, it's not about the long end, but I do think bonds are an effective hedge here against recession risk. So as I've described, over the past month, I see growth risks having clearly risen across the global economy. And yet you've got the 10-year Treasury yield basically in the same place that it started April at the end of April. That to me is not consistent with a Fed which now is clearly going to be hesitant to be perceived to be cutting too quickly, and pressure from Trump, I think, provides even more encouragement for Powell to wait and really see the whites of the eyes of the slowdown in the data before the Fed cuts. But you shouldn't confuse a Fed which is slow to cut with a Fed that wouldn't cut aggressively if the economy rolls over later in the year. So I think payrolls today is going to be interesting because it's very easy to dismiss this data as really not that significant. But we know once the labour market data shows evidence of a weakening US economy, that's going to be the key signal to bring the Fed to the table.
Why aren't stock markets going down? I mean, you talk about treasury markets and the stabilization we've seen. When you look at stock markets, we're also effectively where we were before the April 2nd announcement. And yet you look at McDonald's, pretty concerning. I mean, they're seeing a massive downturn in traffic there. You're seeing companies left and right cut guidance or withhold guidance. And yet the market's been pretty resilient. So I genuinely, I wonder why investors aren't more concerned.
Yeah, I mean, let's be clear. I think the market has this wrong. I don't think you can justify the extent of the rebound that we've seen over the course of April. Important to recognise, the US economy came into this shock in good health. This is not an economy which has built up too much leverage and requires a very big rebalancing. This is a policy choice to shift the US trading relationships. But even just this level of uncertainty is what concerns me. So my question for CEOs today would be, okay, you've heard about the rollback of tariffs and the pause, but would you rather now know what the tariffs are going to be, even if they're higher than you'd like, and be able to work with that scenario? Or actually is the more economically damaging issue here just a prolonged period where we don't know what's going to happen? Because it's that decision just to pause on investment and hiring that makes me more concerned about the path of growth ahead.
When it comes to the Fed, if we do see the Fed decide that it's time to cut interest rates, how much of a support will that actually be to the U.S. economy, given the uncertainty that's weighing on CEOs is coming from the trade agenda?
Yeah, I think the Fed is limited in its ability to help in the short term. However, you think through the next 12 to 24 months. At the moment, we're going to see upward pressure on inflation. I think Powell is going to be very hesitant to get going. But you think about the ability for the Fed to loosen financial conditions over that course of 1 to 2 years, I do think that matters. It helps to reduce some of the strain on the US consumer. It helps businesses to keep refinancing. It'll help the private markets as well to keep that refinancing activity going. So the Fed can help. What they can't do is make an immediate impact to take all of this trade uncertainty away. And therefore, I think it's quite right that Powell is patient here. But this is where I think sometimes people are muddling the idea that the Fed is going to be really, really cautious in moving too early, and rightly so, with a Fed that won't be able to move at all if the economy slows much more clearly.